Another thing that I think is key in all of that is delivering results. I know you guys are clearly liking Thule for all the cool stuff we offer, because I see you out there when we have a product expo. But I know it's also very easy to say you wouldn't like us if we didn't deliver great results. So growing sales is a way to survive as a company. If you don't grow sales, you will struggle to survive. So growing sales is something we've done for a very long time. Since we became stock exchange listed, we in fact had a CAGR of 11%. But we clearly admit that we have been boosted during the pandemic. We've been helped by the staycation trends, and you can see that on our numbers, that our growth rate has been higher the last 2 years. So a lot of the analysts, and I'm sure a lot of the investors, will be asking the question of the long-term sustainable growth. We are very confident in our long-term sustainable growth, and that's what we will be talking most of this meeting about. Then we clearly also have a point of that growth making money. It is very easy to talk about growth, but profitable growth is what makes companies great. So we have shown that that growth that we generated of an 11% CAGR has been generating an Ebit growth of 19% CAGR since the stock listing. And if the ones, and we have quite a few investors that have been with us since we became listed, you remember that we first presented that we would have an Ebit margin of above 15%. We reached that 2015. We then set a new target to reach 17%, which we did 2017. We then in 2017 raised the target to 20%, which we hit 2020. When you now look at it, I have a lot of expectations that people said, then you must have an Ebit margin target of 30% by 2030. So I will disappoint you early on in the meeting. That's not the case. We will, though, keep our Ebit margin target of above 20% with very strong growth, as we will come back to. So we are at a high profit level, and we will continue to deliver great profits. Over the last year, in 2021, and in this year and in next year, we're dialing up the CapEx spend, which historically has been around 2.5%. We're going to be around 5% these 3 years, and the logic is simply twofold, or actually even three, because some of you have already looked through the press release and know that we're launching new products that we will manufacture in our own in-house facilities, but I'll come back to that. But the first two is actually for the existing categories. Number one is that during the last few years, our sales growth was above and beyond what we planned for. We have therefore anticipated some of those CapExes needed to cost efficiently mass manufacture those products. We were able to meet a lot of the demand during the pandemic, but it wasn't in a way that you ideally would want to run factories. It was 3 shifts, it was nighttime, you had to have trucks coming in. Those things are actually not the most cost efficient when you work with manpower and assembly and a lot of products. They work well when you have a processing plant that you want to run all the time, but in our type of business, it's actually smarter if you can to work on a more logical shift level throughout the weeks. So one reason is to be able to have the capacity that we needed already. The second one is we are automating more. And strangely enough, people don't realize that always, but automation takes a lot more space because you need to have automated guided vehicles that are not obstructed by things. So you create space to enable to invest in robotic assembly. Then the robotic assembly as an initial investment is higher, but you do get a lower running cost over time. So we are, for the current business, doing both those two things, expanding capacity for the current volumes and the future growth, and increasing our automation levels. Those are driving up. From a pure reporting point of view, I therefore also want to update to you that the way we will report going forward as of Q2 is the Active with Kids category of today, which is then bike trailers, bike seats. It's also strollers and child carrier backpacks. We will add the dog transport products and the car seats into a new bigger category called juvenile and pet products. That makes us comfortable also then to dial up our ambitions. So what we are doing is basing it on these trends, that there will be things going on, there will be more outdoor and urban activities, there will be more staycationing, there will be a healthy, active community that wants high-quality brands, we've decided to up the ante on our goals. So what we are doing is, when we only about a year ago, so we quickly updated that goal, we presented a year ago a goal to double our 2020 sales by 2030. Since we did 7.8 billion SEK, that would have meant that we needed to deliver 15.6 billion SEK. Now, a year later, hindsight is easy, we were not aggressive enough. We are now convinced that our 20 billion SEK goal is the right goal for 2030. We're basing that on two factors of why we're updating the goal and adding 4.4 billion SEK more in the ambition. And one is the fact that we grew so much more in 2021 than was expected. So we've already caught up with about half of that with the growth that we did in 21. Second part is that we can now be more open about the new categories we're going in and the size of those categories and what it will be for us in achieving also growth in those categories. So a new updated sales target of 20 billion SEK by 2030. We're maintaining our high EBIT margin, or maintaining an EBIT margin over 20% throughout the period, and we're also maintaining a minimum 75% of annual net income, which was updated a year ago. We are continuing with the very ambitious targets we've already set according to the Science Based Targets Initiative. So we are generally amping up on the sales volume, but the rest of the goals are remaining the same.